Assalamualaikum and hi everybody. It is Emazul and Finance, and today our lesson is about types of regulation commercial banks face. In this lesson, what you need to take home are three things. First, you need to know 6 major types of regulations commercial banks need to face. Second, the layers of protection provided under safety and soundness regulations. And the third one is knowing the difference between inside and outside money. There are 6 types of regulations that commercial banks need to face. Number 1 is safety and soundness regulation. Number 2 is monetary policy regulation. Number 3 is credit allocation regulation. Number 4 is consumer protection regulation. And number 5 is investor protection regulation. Oops, I forgot. Number 6, the last one, is entry and chartering regulation. Let us look at number 1, that is safety and soundness regulation. Under this regulation, there are 4 major concerns surrounding the clients and the banks themselves. There are liquidity concern, sudden increase in claims, sudden increase in deposit withdrawal, and concerns about monitoring and surveillance. To address these concerns, banks have layers of protection. The first concern is related to low liquidity. Low liquidity means banks are not having enough current assets to manage its liability. So, to protect banks from falling into this problem, regulations limit banks from giving loan more than 15% of their equity. In some cases, it could go up to 20%. If a bank has 10% of its asset funded by own capital, the 90% of its must be from liabilities. In that case, bank can lend not more than 1.5% of its asset to borrowers. Okay, the second concern is the potential increase in lenders' claim if they heard that bank going to be in insolvency status or bankrupt. We must remember, in the event of such problem, the bank must resolve the lender's claim first. If there is an excess, then it can be passed on to the equity and shareholder. So, to mitigate this risk, regulation requires bank to analyze its minimum level of equity or capital funds that the bank owner has to contribute to finance the bank's operation. Ideally, the more owners contribute to the capital, the greater the protection is for banks. The third concern relates to drastic withdrawal by depositors if they smell unfavorable news about the bank. To avoid from bank run, that is, depositors withdraw their money, regulators requires bank to have their funds allocated in insurance. In Malaysia, the regulation protects the depositors under what you always heard, PIDM, or Malaysian Deposit Insurance Corporation. Under this regulation, your money is guaranteed safe by the bank in case of bank runs into problems. The fourth concern is regarding banks' operational risk and risk of behavior of banks' personnel. It is a concern in the event where bank manipulates or perform activity which deviates from a predetermined course. This has happened in the famous case of Wells Fargo Bank, where they were found to perform illegal practice that was opening 1.5 million deposit accounts and 565,000 credit cards forgery cases. Thanks to the regulations which protect the depositors' interest, bank employees are required to take on an off-site examination as a precautionary measure. Second regulation that bank has to face is monetary policy regulation. Monetary policy regulation is related to monetary policy conducted by central bank. Within the central bank, there are 2 types of money. The first one is outside money, and the second one is inside money. Outside money consists of paper money and coins, while inside money is money from commercial bank deposits. The regulation that commercial bank has to face is the requirement by the central bank for them to keep the cash in the central. Although normally the account is non-interest bearing account, commercial banks would be more inclined if they could have the money to serve as liquid assets rather than keep it in the central bank. Coming to the third regulation that bank has to face is credit allocation regulation. This regulation requires banks to comply with regulators' requirement when they provide loan for socially important sectors like housing and farming. These sectors are usually heavily subsidized by the government, and under social welfare policy, bank is expected to meet asset and interest rate restrictions. For example, in order to comply as loan provider, commercial banks need to hold 65% of their assets in residential mortgage and to qualify certain lender tests. On interest rate restriction, banks have to ensure that they do not charge maximum mortgage rates. The fourth regulation bank has to abide is Consumer Protection Regulation. This regulation prevents discrimination by banks on the basis of age, race, sex, or income. In the US, for example, banks have to abide by Community Reinvestment Act or CRA and Home Mortgage Disclosure Act. In ensuring banks to follow the regulation, they have to disclose their CRA ratings and provide information on lending analytics. Even there, they must give the fourth regulation bank has to abide is Consumer Protection Regulation. Okay, this regulation prevents discrimination by banks on the basis of age, race, sex, or income. In the US, for example, banks have to abide by Community Reinvestment Act and Home Mortgage Disclosure Act. In ensuring bank follows the regulation, banks have to disclose their CRA ratings and provide information on lending analytics. Even they must give reasons if they deny credit or grant them. These are all done to protect consumers to be treated fairly. Investors who use banking platform to trade securities or funds that are managed by commercial bank is protected by regulations. Alright, the fifth regulation is Investor Protection Regulation. This regulation will protect investors against insider trading, lack of disclosure, outright malfeasance, and breach of fiduciary responsibilities. In Malaysia, we have Securities Act to safeguard investors from this malpractice. Federation of Investment Managers Malaysia also functions in a dual capacity. They act as a self-regulatory organization and as an industry representative advocating the development and growth of the unit trust scheme and private retirement scheme industry. For banks, this regulation imposes burden as they are moving towards financial liberalization by offering more investment banking and mutual fund services. The last regulation is Entering and Chartering Regulation. This regulation protects finance and banking sectors as a whole. It was done by limiting the number of banks allowed to be operated. Too many banks would cause higher competition, therefore affects the sector's profitability. The regulation protects the new entrants by imposing high capital requirement or even restricting types of individuals from entering the sector. So guys, let us recap. There are 6 types of regulations that commercial banks need to face. These regulations are regulated by regulators, which comprises mostly government agencies led by the central banks. Although they seem to impose burden to banks, these regulations are done to protect both the client and the bank itself. That's all for this lesson. Till we meet again. Bye.